the active versus passive investing and where to park your cash webinar. Really appreciate you all being here on this evening. I am joined here by Joe Massey with Castle and Cook Mortgage. Joe, how you doing?
I'm doing outstanding, Nick. Thanks so much for having me. I always enjoy these, and really grateful for you guys bringing me on again.
We're grateful that you're here. So thank you for being here. And I'm also joined here by the one and only CEO and founder of Ironton Capital, Lon Welsh. How you doing, Lon?
Fantastic. Thanks for having me here tonight.
Yeah, absolutely. Thanks for being here. So we've got a lot of slides to run through, a couple of housekeeping items for those who are on. There's a chat box on the right-hand side. So feel free to type your messages or questions as they come. We will do our best to address them live. If not, we will address any remaining questions towards the end of the webinar. So with that being said, Lon, I'm going to go ahead and just turn it over to you.
Fantastic. If you put in full screen mode, just so it's a little bit easier to read all these guys, that'd be fantastic. So thank you guys. Welcome to Ironton Capital. And today I hope that you'll discover our proprietary formula to diversify your portfolio so you can get maximum returns in any market condition. We're going to give you a lot of ideas you can use today. Have you ever wondered what it would be like to wake up in the morning with all the time that you need to do what you want rather than what you need to do because your investments are making returns on autopilot as opposed to your tenant has a disaster, you've got to go put out a fire somewhere? Would you like me to share with you how you can get more diversified with your portfolio with less work? My goal is to share with you how you can get higher returns, manage your risk, and understand how to work passively and have a little bit more fun in your life. So the problem is a lot of investors are making decisions based on what they hear on CNBC or what they hear at the coffee shop, and they're not aware of all of the cycles of real estate investing or the trends in the nation, let alone like on a local basis where you actually have to make your operational decisions. And that's not your fault. After putting in long hours on your career or your business, very few professionals have the time or really the inclination to dive deep into the numbers and the trends. So as you listen to us tonight, our goal is to be able to synthesize a lot of that homework for you and give it to you on a silver platter so you can make decisions a little bit more easily. So for those of you who are newer to this, what is passive investing? So most of you who are on the call tonight are probably active investors, as I've been for a couple decades, where you actively own real estate and deal with all of the work of the tenants, the property managers, the banks. So passive is just to take yourself away from managing contractors and renters and having someone else do all the work for you, and you just get the returns at the end of the day. So we all know knowledge is power, and I want to give you the knowledge you need to be able to act on passive investing. So I'm going to show you some case studies and some hard data today. None of this should be interpreted as a claim of income or otherwise. Just a quick love letter from the attorney that I'm required to read is that there's some forward-looking statements in our presentations. You hear words like would, may, should, expect, plan, seek, anticipate. These are all based on our best understanding of the market, our analysis, what we've heard from different sponsors, but you'll want to validate everything that we look at together with you today with your CPA, your financial planner, and your attorney. A lot of the information here is company sourced either from us or from sponsors that we work with. The material I'm sharing tonight is not an offer to invest. If you do find this of interest, I can share the subscription agreements with you, which go through all the risks and all of the terms, so you can make a really well-educated decision with your entire financial team. And of course, investing in real estate does have some risk involved with it, so you probably already had a pretty good handle on that. So let's talk a little bit about the investment team. Why would you want to listen to us? Well, here's the three guys on investment committee, Brent Geyer, Richard, and I. The three of us have all been at this for at least a decade each or a couple decades each, and we've got extensive experience in delivering at least over 20% annualized rate of returns. So I'm very, very excited to have two colleagues that have got such great deep expertise. Okay, so the fastest and most predictable path to financial security and growth is passive investing. So if you could put your investments on autopilot, you're on the way to what your financial goal is without having all of the rigmarole of fighting with the day-to-day every day. So I believe that what we all want is the freedom to experience life to the fullest while we're still healthy enough to be able to enjoy it. And ultimately, that's what our training is about. So think for a moment how good you'll feel when you can stop trading hours for dollars and actually enjoy your travel hobbies and different charity work that you do. So our mission today is to give you the information you need to do that. What are the challenges? There's a lot of them out there. It's difficult to sort through all of the information in the market, all the things that come up on ChatGPT, and find the lucrative patterns. So we want to add more investments to our portfolios, but there's only so many things that you can manage and keep track of. Our portfolios have to be bigger before we can really participate in commercial grade investments. And that's a limitation that a lot of smaller investors have. So a lot of you guys have invested and educated yourself as much as you can, and you've acquired assets that are eating up a lot of your time, taking away from your family and your hobbies. Almost feels like you've got another full-time job. So what we've got is a number of solutions to that problem, and I won't go through all these today. We've got a diversified fund that's a long-term fund, generates about a 17 to 20% annualized return. We've got single asset funds periodically like Hill Point, but the two I'll talk about primarily today are the short-term income fund as a place to park your cash, and the medium-term income fund, which for many of you who need to have income on a regular, reliable basis, will be a good solution to be able to generate that for you. So what is different about passive investing? So imagine and picture a simple investing system that allows you to access high-grade investments passively. You don't have to do the work yourself. It's a simple system that's the backbone of your real estate investment portfolio. And imagine that you're continually feeling lighter as weight is lifted from you and you don't have to do the day-to-day responsibilities. So active investing is managing your credit score, managing your cash available to invest, understanding the market, deciding what you want to buy, deciding where you want to buy it, deciding which particular property, negotiating it, going through the lending process, personally guaranteeing the loan, so you're on the hook if things don't work out, managing all the construction, figuring out who your property manager is going to be, and then everything else that goes into that. It can take up quite a lot of time. I've actually run a real estate brokerage for about 20 years. I have about 700 agents who work for me, and I've led a lot of classes on active real estate investing. And one of the first books I wrote was a guide to investing in Colorado real estate. And I started the book off with a flow chart with a bunch of questions that a prospective investor on the active side could ask themselves. And based on how they answer the different questions, I would tell them which type of investing was likely the most appropriate for where they were in their active investing lifestyle cycle. And then there was a chapter on each of those to get going. And what I found over time, and a lot of you guys in this call have been in my classes, is that if I had 20 people in a class, I'd have one person who'd go on to actually go buy a fourplex with us. And the other 19 would say, this is interesting. I see the power of investing in real estate. I don't have the time to do this. I wish somebody else could do this for me. And that was really kind of the genesis of what led us to form Ironton Capital to solve that problem. And for those of you who are the 1 in 20 who actually went and bought a property, there's a lot of new laws making it more difficult to be a landlord. And it's certainly a lot more in the favor of the tenant than it used to be. So, elements, if you haven't thought about how you want to invest yet, whether it's active versus passive, is that if you haven't thought about it yet, stop by our office at Yale 925. I'd be delighted to give you a free copy of our book on active investing, which will give you everything that you would need to know to decide what to invest in and then how to actually go about doing it. But what you'll probably find is you're going to need a relatively large time commitment to do it. You'll need a fair amount of cash up front to do it, and you'll need to have a large team of people that you trust to actually execute all the work. You'll need to stay on top of all the laws, which recently have been changing a lot, and you'll need to become an expert in a lot of different things. And if you do all that, you'll be able to make some good returns. It's just, I've done it for over 20 years. It's just a lot of work.
It's a lot of work. Yeah.
Yeah. It just never quite seems to let up. So passive investing, you would pick us or someone like us to make investment decisions for you. And we get paid a success fee only if what we decide works out. So we will do the work for you of selecting the project, picking the sponsor, arranging the financing, guaranteeing the financing. So you don't have to do any of that, oversee the construction renovation, manage the property, and sell it at the back end. So it's all off your plate. So let's go through a case study. A lot of you guys on here are active landlords, and you may or may not still enjoy it. So one of the things I do many times every week is do a financial analysis for someone with their long-term or short-term rental. And if you have one that you're questioning, even if you've got a phenomenal loan on it, set up an appointment with me or with Nick, and we can very quickly help you figure out if you continue to hold on to that rental over the next 10 years, how much wealth will you generate for your family? If you decide to sell it and not do a 1031 exchange because you're kind of done with this and you paid the taxes and you invested in the stock market, what would that mean for wealth accumulation? If you put it in the medium-term income fund to generate just pure income and not appreciation, what would that do for you? And then if you decided to invest in one of our long-term funds, well, how would that perform? And then I can give you all the facts that you and your family need to make an informed business decision about what the right path forward is. And it's easy to do. It doesn't take a lot of time, and there's certainly no obligation to any of that. So I'm going to show you something that I did for myself. So I've got a number of long-term rentals. At one point I had 140. I'm down to less than 20 now. I've sold a lot of them off. And I've got about a dozen short-term rentals. So this is an Airbnb on Bijou Street in downtown Colorado Springs. It's a beautiful Victorian. It's been fully renovated. It's just a couple blocks away from downtown in a primo location. And I've had 4 or 5 years of really great financial performance from this asset. It's really had some great returns. Unfortunately, there's a lot of people with really low mortgage rates, thanks to Joe Massey.
You're welcome.
Who don't want to sell their rental properties, or sell their properties rather. So if they're getting transferred to, say, Dallas, and they're a financially strong person, they will be able to buy a home in Dallas and still keep their old home in Colorado Springs or Denver. And half of them are putting it into the short-term pool for Airbnb, and the other half are putting it into the long-term rental pool. So the amount of competition on both the short-term and the long-term side has increased quite a lot recently, thanks to all these people who've got really cheap interest rates. The demand for these rentals has increased, but not nearly as fast. So what we're seeing is the short-term rental market is a little bit overly glutted with supply. No one's getting as many room nights, and no one has any pricing power. So here's my Airbnb in Colorado Springs. You can see it's a pretty nice looking place. It's done really, really well over the years. And I did this little analysis to try to figure out, well, you know, my revenue is down a lot. So the blue line is the actual over the last couple of seasons, and the red line is the projection based on what I think is going to happen next. And you can see that in the upper left, like my revenue a couple of years ago was 95 grand, and now it's under 60 grand. But my expenses now are higher than they used to be because insurance has gone up, my property taxes have gone up, and all of my labor costs for everything have gone up. So if you take a look at the cash flow after the mortgage, you can see initially I was generating a lot of free cash flow even after the mortgage payment. And now I'm at break even. I'm projecting to be at a slight loss next year. I have a fixed 5-year loan that's going to reset in February of next year. And then when that loan resets, it's not going to be anywhere close to profitable. I'm going to be like bleeding money on this. So this was not a property that required a lot of advanced analysis to figure out, like, I've got to sell this. But I did this with all my rentals, and there were some other ones that I need to sell as well. So I won't do anything as elaborate as this. I'll do something simpler for you. But if you've got a property where you're wondering, like, wow, should I keep this or is it time for me to sell? I can help you think through all those topics to figure out what you should do. How do you do that? You go to irontoncapital.com /book now, and you can set an appointment with any of us on the team. Joe, are you seeing for people who decide they still want to be an active investor, like, are the rates favorable enough that it's easy to get something to cash flow?
No. If you are buying a property right now based on insurance, taxes, HOA, and interest rates, you got to put best case 30% down to break even, 35 to 40% down if you really want to cash flow.
That's what I'm seeing, and our expectation. Well, I shouldn't lead the witness here. Joe, do you expect that mortgage rates will decline quite a lot over the next couple of years now that the election is behind us?
I do not.
I'm in the same boat. I think that you're going to see rates drop a 1/4 point or a 1/2 point over the next year, but I don't see they're going to drop materially. So the people who are not active investors who have the desire to be an active investor may not really have a choice in that there's not a lot in the near term they're going to be able to buy that's going to cash flow really all that well, unfortunately.
Hey, Lon,
nothing lasts forever. Yeah, go ahead.
I add some of that. So I had an interesting conversation with an investor yesterday who's looking to 1031 about $230,000 from the sale of 2 parcels of land. And he could not find anything to cash flow. He's looked at about 10 to 15 different properties. And every single property that he looked at, he would be sucking about $100 per month into the property, which I found to be very interesting because I think that's really a sign of where the market is. And I think it's a reflection of the interest rates, the rents that are out there, and the type of property from a valuation standpoint that you're going to have to buy. So I thought that was a really interesting conversation that I had with that individual.
That's great. So a lot of people who currently own a property and are sort of tired of being a landlord are really worried that the capital gains taxes are going to be really a large barrier from doing anything other than a 1031 exchange. And you'll want us to do the analysis for you so you can see exactly what kind of impact that has. Usually we find that over a 10-year period, it's okay to pay the taxes, especially since we can usually offset some of them with our depreciation, and that you might do okay. So Paul was asking, do we qualify for a 1031 exchange? Not directly. So the long-term fund, Paul, has got one share class without depreciation and one share class with depreciation. So a lot of our investors invest with, say, an IRA, so they don't need depreciation. So the small number of people like you, for example, could get a disproportionate amount of the depreciation that our investments generate. So you'll want to talk with your CPA, but what we generally tend to find is that the depreciation we generate in the first year can be used to offset a decent amount, sometimes quite a lot, of the 1031, the capital gains that you would experience from selling a rental property. So it's not the same mechanism as a 1031, but it accomplishes a lot of the same results, and we can model your exact situation for you.
It's kind of like a 1031 light.
Yeah, that's a good way to express it. Absolutely. So I'll just talk briefly about the National Diversified Fund. This actually kind of fits in with Paul's comment. Our goal is to invest for 4 to 6 years, a 17 to 20% return, and there is an option for accelerated depreciation you can use to offset the capital gains you might have if you sell a rental property. If that's of any interest, let Nick or I know, and we'll get you a lot more information. I want to mostly focus about where to park your cash tonight because that's our theme. But for many of you, this might be part of your solution.
Hey, Lon, I got one common question I get, and for a lot of people on here, maybe you are new to passive investing. Is that 17 to 20% annualized, or is that total over the 4 to 6 years?
That is annualized. So the goal would be on a typical fund, if you put 100,000 in, that we would return your 100,000 back and about 90,000 of profit on top of that. And our goal is that the majority of that return is a long-term capital gain, not ordinary income. So it's a more favorable tax bracket. And we've run about 15 of these funds over the years. So this is kind of our overall list of all of them that we've done. And you can see the initial IRR, that's internal rate of return, so return on investment, annual target, and then what our current estimate of where those will come in at. Okay. We talked about all of that. So one of our clients, Jay, has been really excited that we've been able to reduce the time he spends on investing and the headaches he's had. He used to manage his own residential rentals, and I think we're likely to do a better return for him than what he was getting on his own with a whole lot less work, which is really going to change his life quite a lot. So where to park your cash at? There's really kind of 2 large components that go into that, short term and medium term. So for many of you, you probably have 9 to 12 months of cash of your total living expenses sitting on the side. And you'll probably want to have a couple months of that extremely liquid at Chase Bank or Wells Fargo, and it's not making very much. But the rest of the money that you've got, there's probably a couple different things that you can do with that. Those of you who are landlords may also have some funds that you need to have in cash or near cash, in addition to your emergency reserves just for your household. So for example, I own 3 office buildings and a warehouse, and all of them have got large capital projects coming up over the next decade. So I've got elevator replacements, roof repairs, boiler replacements, and I'm saving a little bit every quarter towards all those different goals. I've also got like lots of security deposits I've got to keep track of. So what can you do with it? So I asked our research analyst a couple days ago to go online and search, if I just look for savings accounts, what are my options? And you can see most of the options are, well, the average is like 0.6%, but you can easily, do the same search that we did for you here and get something in the 4 to 5% range. And that's a pretty liquid option. So what we have that's analogous to that is our short-term income fund. And our target is to be between an 8 and 9% annualized return for you. The more you have invested with us, that's called assets under management, AUM, the higher the returns that we'll be able to pay you. And there's a little bit of variance from one quarter to the next, but not a lot. So it works out to about a 2% return per quarter. So the goal is not to appreciate in value. It's all just liquidity and dividends. So how liquid is it? Usually on 30 days notice, we can get your cash out. So you're going to want to have some of your cash still at a Wells Fargo, but a lot of your cash over and above the immediate needs could be at a place like the short-term income fund, making 8 or 9% instead of 4 or 5%. And over a long period of time, it's a really big change for you.
Hey, Lon, can I ask a question?
Yeah, please.
So with that dividends paid quarterly, is that paid out like I would receive a direct deposit, or do I have an option to reinvest that money?
At the moment, we send the money to you every quarter, but we should have the ability to reinvest it for you sometime here shortly.
Okay, cool. So there might be an option in the future for that to compound.
Yes, our current software platform doesn't really lend itself to that, but we're in the process of upgrading. I hope by first quarter of next year, and that'll solve that problem.
Cool. Thank you.
Great question. I'm glad that you asked that. Something subtle that really adds up over time is that the short-term income fund is taxed as a REIT, a real estate investment trust. And of course, talk to your CPA. But for most of you guys, that's going to be a 20% tax rate at the federal level. If you're a high income household, your tax rate at the margin might be, what's the top tax rate now, Joe, like 35 or 38?
37. And if you're in Colorado, plus another 4 states, so 41.
Yeah. So we can almost cut your tax bill in half on the dividends that you receive with a short-term fund because it's a tax advantage fund. And Will was asking, yes, it's a quarterly distribution, not a monthly on this particular fund. So I put in here just a quick example for you. If you, on the middle column, had your money at Wells Fargo making a 3% return on your savings account, and your marginal tax rate is 39%, your return after tax is 1.8%. On the other hand, on the right-hand side, you use the short-term income fund, your pre-tax return would be 8, and your marginal tax rate would be about 20 for federal and about 3 or 4 for state. So your after-tax return would be a little above 6, or about triple. Does it matter? Well, with $100,000 over 10 years, it actually works out to about an extra $62,000 after tax, which, that's a lot of money.
That's a big number in my world.
Yeah, like that's enough to send a kid to college for a couple of years or go on like a couple of really amazing vacations or, a lot of other projects. So this is the terms you might be able to get for medium-term investment with a 1-year CD, 4.25. Some of these are a little bit low. That can't be a CD for Chase. It must be something else. I think you'd be able to find, if you hunted around a little bit, something closer to 5%. So our medium-term income fund is the other alternative for parking your cash. And our goal there is an 11 to 13% annualized return. This only varies based on the assets under management. So the more you have invested, the higher the rate of return we can pay you. Again, it's also paid quarterly. And the objective of the fund is only to generate cash flow. There's no appreciation to it at all. So the negative on medium term is there's no liquidity for the first year, and you need quarterly. You need to give like a quarter's worth of notice, so about 90 days notice to get cash out when you need the money out. So it's not instantly available like your Chase Bank account, and it's not available on a month's notice like the short-term income fund. So you'll want to use the medium-term income fund for parking cash that's got a slightly longer horizon, and then the reward is that you get paid quite a lot more. Something significant that I think is an interesting advantage about the medium-term fund is that it's not correlated to the real estate or the stock market. And what I mean by that is the real estate market and the stock market are correlated in one regard, in that they're both very sensitive to interest rates. Historically speaking, the stock market in times of higher interest rates doesn't tend to appreciate as much, and oftentimes it'll depreciate and go down in value. Real estate, if you rewind a little bit in time, you can think about 2018 through 2021, the mortgage rates were very low and the appreciation rates were relatively high. So the profitability of real estate was very excellent. If you remember, Joe, when did the rates go up? Was it like March, April 22?
April of 22.
When the rates started going up for the mortgage rates, the appreciation in the real estate market slowed down very dramatically, and it became much more difficult to do profitable projects in real estate once the interest rates went up. So when I talk about two types of asset classes like real estate and the stock market being correlated, all I mean is that they share a dependency on interest rates for the amount of wealth they can generate for you. When rates are low, both real estate and stocks do well. When rates are high, both real estate and stocks tend to suffer. So if your overall portfolio is, and this is my problem, probably is for many of you, is primarily focused on real estate, stocks, and bonds, you've got a lot of unintended exposure to interest rates. And during the times when the interest rates are high, your portfolio is going to suffer. And if you're in retirement mode without an active job, you may not be able to pull out as much money as you'd like to each year because of the high rates. Now, when the rates are low, you'll probably have excellent returns. You'll have no problems meeting your targets. So this brings up a concept of it would be desirable to have some part of your portfolio in an asset class that is not correlated to interest rates. And that's what the medium-term income fund is. So we're not actually investing in anything real estate related here. Our short-term fund is primarily private loans to people doing fix and flips or renovation projects. The medium-term fund is primarily for medical receivables. And what I like about that is that it's for people who get involved in a car accident. One person might have Geico and the other one might have State Farm. It's not clear who is at fault, and they're going to have to go to court to be able to figure this out. And it might take a year or two for the attorneys to battle it out. Meanwhile, you've got physicians and clinics providing healthcare services to the driver to get them well. And all those people, the guy who ran the MRI, the person who gives out all the medicines, the person who does the surgery to repair their shoulder, they need to be paid now. They're not going to wait 2 years when some attorney figures out who's actually at fault. So in a lot of cases, those physicians and clinics will outsource collection from the insurance company to our sponsor. We'll take it over, and then we get paid for doing that. So there's tens of thousands of medical invoices that secure the fund, providing a lot of diversity. But more importantly, it is not correlated to interest rates. People get into car accidents all the time. It doesn't matter if rates are high or low, if there's a war in Ukraine, if a Republican or a Democrat wins in office, none of that matters. People get in traffic accidents all the time, no matter what. So you can count on this fund to reliably generate the same levels of income all throughout the economic cycle. High rates, low rates, wars, no wars, different types of administrations with different political affiliations, doesn't matter to us. So I'm really pleased to have part of my portfolio be diversified and reduce some risk in that manner.
Hey, Lon.
Yeah.
Can I pause you there? You said something that I think is really important that a lot of people may not realize. If I've got, Microsoft stock and NVIDIA stock and, one or two rental properties, a lot of people don't realize that even though it's stock market in, two buckets and real estate in another bucket, and I feel like I'm diversified, I think you hit a really strong point that a lot of that is still impacted by interest rates. And so there's some hidden correlation that folks may not recognize. Would you agree with that?
Yeah, I think this is true across most of the different stocks in the overall S&P 500, for example.
Yeah. So I think this is a really smart way to get true diversification that's not tied to any of those economic factors that impact the stock market and real estate. I think it's very smart.
It takes a lot of risk out. So, Nick, when you're talking to investors about short-term and medium-term, what are some of the topics you tend to go through with them?
I mean, a lot of it is focused around that. I mean, there's one thing that a lot of our investors who are near retirement or perhaps in retirement, or perhaps they sold rental properties and they just need to replace some cash flow that they were originally getting from that rental property. They like the consistent predictability of the cash flow coming in from an investment such as this. Right? Even if you have a rental property, maybe it's paid off, maybe you have some cash flow coming in. There's a lot of risk that can come from just owning a rental property, one or two, right? If you have one asset and that tenant moves out, you now have zero income for who knows how long, right? And so what investors like is the diversification. And even though this isn't one investment in one asset, it's diversified across 25,000 medical invoices. So hypothetically, if one invoice went into default, there's a ton of downside protection. And there's likely to be a very minimal, if any, hit at all to performance, right? But even still, if that does happen, you're still anticipating you're getting your 11 to 13% fixed per year. So that's what investors really like about the medium-term income fund. It's consistent, it's reliable, it's predictable, and they can forecast their finances very well by being a part of this fund. In the short-term income fund, investors still who want to be in real estate, they get diversification through real estate. But as opposed to being on the equity side, they like being a part of the debt side, which is really great. So to be in a senior position loan arrangement through a debt instrument such as the short-term income fund is highly favorable to a lot of our investors who want both exposure on equity and debt.
Yep, exactly.
So there's a really good
question. So it looks like.
Oh, go ahead.
Go ahead. Yeah, please go ahead, Joe.
So Darren asked, with a medical fund and no exposure to interest rates with a return of 11 to 13, why shouldn't we consider a much larger investment in that particular fund versus some of the other programs? So if you'll answer that one first, then I'll follow up with some others.
The big problem with MTI is the lack of liquidity for the first year. So if this is truly just parking cash, so let's break it into a couple buckets. You've got 2 months worth of living expenses that you might need on super short notice. MTI is a terrible choice. You want to just keep that at Chase Bank making 1%. Then from say 3 months to 6 months of your living expenses, that I would really encourage most people to do the short-term income fund, because if you need it, I can get it out for you in a month's notice. And you've already got 2 months set aside at Chase. So you're not going to have any cash flow hiccup. Like if you and your spouse both lose your job and someone gets sick, your cash flow is covered. When you start looking at more than 6 months, probably more than 9 months is where I'd start looking at putting medium-term income fund in. What I wouldn't want you to ever be in a position where you could burn through all of your short-term savings. You've got a bunch of money in MTI and I can't get it out for you fast enough. And then you're like in a really stressful situation. So MTI won't always be the answer. Once you've got enough money that any realistic conceivable problem in 12 months or less could be covered by your reserves in Wells Fargo or our short-term fund, anything left over, medium-term fund becomes a very good choice. Nick, would you say that the typical MTI investor tends to be a little older, maybe selling a lot of income properties that they were relying on that income to support their lifestyle? Now they're relying on MTI instead to support their lifestyle?
Exactly. And oftentimes they're getting even more cash flow through the medium-term income fund than they were getting on their rental properties anyway. So, there's also that bonus to it. I wanted to highlight one more question Darren had there. Darren, if hypothetically somebody invests in MTI, the dividends start right away. So the 1 year lockup only applies to the liquidity. of the investment. It doesn't apply to the returns of the investment. So if you invest day one of the next quarter, you'll get your first dividend payment will be of that quarter, right? But you cannot access that capital until pretty much day 366 from the time you wire funds. So that liquidity the 1 year hold only applies to liquidity. You get your dividends starting right away when you fund your investment.
Yep. And I think Darren's asking if I don't need the money for a while and liquidity is not important. MTI is an excellent choice. It's actually one of the most popular choices that we've got. If you don't need liquidity, this should be at the top of your list.
Hey, can I ask?
Yes,
Oh, go ahead, Lon.
It's about 3% per quarter.
So I have a question here. Let's say I've got an investment property and it's giving me, I'm going to make up numbers for a minute. It's giving me $1,000 a month in cash flow, which may, it's a property I've held for a long time. And I've got $200,000 of equity after selling costs, capital gains, et cetera. Could I split up that $200,000? Could I put $100,000 into the medium-term income, and that's going to generate approximately $12,000 a year to solve that I'm still getting the same cash flow, but then could I put $100,000 into maybe the National Diversified Fund to get a higher percentage?
Yeah, absolutely. So I'm so glad you asked this, Joe. So we've had a lot of clients that have sold multiple rental properties that had retired, so they didn't have any W-2 income coming in anymore. So usually the first exercise we'll do is figure out what is your lifestyle requirement after your Social Security payment, and it might be I need $100,000 a year. So then we'll figure out how much MTI do we need to purchase to get that $100,000 a year, plus maybe like a little bit of a margin on top of that. And then whatever's left over, you can allocate it out however you want to. And typically the long-term fund is the choice. That's what most people do end up picking. So that's a really great solution. Joe, so like if you've got someone who's got a ton of equity in one of their rental properties and they want to put on a second mortgage to tap that, how would they go about doing that? And how would they maybe pair it up with that strategy?
Yeah. So, what we would do is look at either a fixed rate second or a home equity line of credit that we could give, let's make up numbers again, $100,000 or $200,000 cash out. You could figure out how much is that payment going to be on the HELOC. Maybe it's $500 a month, and you could put $50,000 into the medium-term income fund that's going to pay you, a quarterly dividend of $1,500 a month. So that's not going to change your cash flow on the property. Now, the money's coming from a different source, but the cash flow globally remains the same. And then you'd have $150,000 left over to invest into either the short-term fund or the long-term National Diversified Fund. So that's something I've worked with a number of investors on doing. If they like the rental property, but it's got a lot of equity that they feel like is not giving them a good enough return, that's a way you can diversify that equity out into a couple of other additional investments.
So a common situation like that is you have someone who likes doing a development project like every other year or so, and they've got a couple of rental properties in, let's say, like DU, that's phenomenal location, would clearly be a great place to go knock down an old bungalow and put up a duplex, but now it's not the right time for whatever set of reasons. But they've got a ton of equity in that property. The strategy that we just heard from Joe would be a very common way that they would harvest the equity, get some extra gains on it, and then down the road, then they can unwind it when they're ready, on their terms, on their timetable, to knock down the house and do their development project. Gives them a little bit more flexibility. Nick, anything else on this slide we should add in?
I don't think so. Rocky asked a great question, and you already somewhat answered it, or you did answer, not somewhat. MTI it's not a very tax efficient vehicle if you are in the 37 plus % tax bracket. Your net, you'll be probably paying a big tax bill depending on the amount of capital you have in the fund. However, if you're like a lot of us, maybe you have a 22 to 24% tax bracket at the end of the year, it's less tax efficient, but STI, but it's not that much. So your net take home will still likely be higher being an MTI relative to STI if you're in one of the lower tax brackets.
We'll also come across people that have got a lot of loss carry forwards, and this is way above my pay grade from an accounting standpoint. So for sure, talk to your CPA about this. But if this is you, where you've had some losses in the past and you haven't had a gain that was appropriate for using up that gain, I would ask your CPA, is the type of income generated by the MTI fund something I could use with those loss carry forwards to shelter some of that? And for some of you on this call, it likely will be. And for you, like, that's going to be a great strategy. Your CPA is going to be a really integral part of all these decisions on how to optimize. Somebody asked about the short-term income fund. So I should probably spend a minute on that. So about 80% of the short-term income fund is with a sponsor that does hard money loans, primarily in the Front Range of Colorado and a little bit in Utah. And the majority of what they do is fix and flip. They do some new development, but it's almost all entirely residential. Their weighted average loan to value is, I believe, 62, 64%. So it's very conservative. And all those loans are backed up by a personal guarantee from people who've got good credit scores. So I'm very, very comfortable. And I've got a lot of money myself invested both in MTI and SCI that they're well-run funds. And then Jaron asked, so a short-term income fund, the dividends is one way to generate cash flow depending on the level of investment. Yes, absolutely. So I see the short-term fund as we don't have very many people who have got a lot of money in short-term. There's a lot of people with 50 grand, 80 grand, 120 grand with a couple of months worth of their living expenses in there. The only exceptions are in there where I've got developers that are active in a project. They've raised money. They want to get a return on the money they raised, but they don't need to spend the money on contractors because they're waiting for permits or whatever they're being held up by. And that's a place to park it. That's typically where we see STI used the most. Oh, I'm sorry. Darren said I was referring to MTI. Yeah. So for MTI, the medium-term income fund, the dividends, they're very, very steady and very predictable. So the more you invest with, the higher the percentage rate is. It'll be between 11 and 13%. Great question.
Lon, a question that I've got too, the short-term income fund, it doesn't mean that I have to take the money out in the short term. I could leave it in there for a year, 5 years, 10 years. The short term just means I can get it out in the short term. Is that right?
Oh yeah, absolutely. My initial investment with that sponsor just as an individual was almost 7 years ago, and that money's still there. I've never pulled it out. It's just compounding every quarter. Yeah. I just like having some money that's liquid.
I agree.
I don't keep a lot at Chase, much to their frustration. All right. So what kind of return history have we actually seen? So for short-term income 1 and 2, our goal was a 7 or 8% return. We're actually running a little bit higher than that. That's because we made the decision to add a little bit of the medical receivables in there, which increased it a little bit. And for MTI, it's the same every single quarter. Like, it's exactly where it should be, which is absolutely wonderful. It's a very reliable set of investments. So John was a hands-on landlord, and he has sold some of his properties and moved quite a bit of it over to us. And I think he's been happy that he's got a lot less risk overall in his investment portfolio, and he feels like he's better hedged against inflation. So he's had a good experience. Jared had a lot of rentals. I've known Jared for over a decade. I know that he had a long period where most of his renters were well behaved and everything worked smoothly. Then he had a hailstorm where like no one could seem to pay their rent, no one could seem to take care of the property, and just like drove him crazy. So he's diversified, sold a lot of those and diversified with us, which has made his life a lot better. And Justin has been able to, retire from running a small business to actually like having a lot of free time, and the passive income that we've generated from him, primarily through MTI, has really enabled him to have a stable lifestyle, which he's enjoyed a bunch.
Can I add one thing to that, Lon?
Yeah, please.
So the quote from Justin, he's a great guy, and it's not listed on the quote there, but he recently moved to Portugal. Moving from his active investments, it'd be very difficult to manage rental properties in Colorado when you live in Portugal. But he's getting a great return and recently moved to Portugal, and pretty cool result, from taking that active management over to passive, and now he can sit on the beach just like this.
Yeah, it's such a great story. He's having such a good time over there. It's like a dream come true. I'm a little bit jealous every time I talk to him.
Yeah. And one question that did just come up for dividends, we can't reinvest the dividends in the short-term income. Is that the same for the medium term? We cannot reinvest those dividends. Is that right?
Near term, that's the case for medium and short term. And as soon as we get the software upgrade, we should be able to automatically reinvest them if that's your preference. I just can't do it yet without killing my accounting team. So I appreciate your guys' patience with me while we do this upgrade. So, picture what it would be like to get your time back, time to relax and enjoy quality time with the people who matter while your portfolio continues to grow. And that's really what I want for you. So if you take a look at the different options, the National Diversified Fund is a 4 to 6 year commitment. It's going to generate 17 to 20% annualized returns. So for the really long-term part of your portfolio, that's going to be great. Short term, for most of you, will be a relatively small amount of cash that you'll probably allocate to it. Medium term, for some of you, could be a relatively large part, depending on if you're more interested in growth or if you're more interested in income. And there's no right or wrong answer to that. So for those of you guys who have financial planners, they'll be able to give you some good input as to how you should allocate across those different buckets. And then our single asset, the one that we've got at the moment is one called Hill Point. And if you're curious about that, either Nick or I would be very happy to fill you in on that on a call to set a time up with us. Let's see what we got here. Darren's asking, I know there's funds like BlackRock at Vanguard that have similar opportunities. And if I had to guess, the difference would be that we know who our money managers are and who the analyst is, and I have more of a one-on-one relationship as opposed to some multi-billion-dollar fund. Measure the fee structure a little bit better as Ironton as well. Yeah, we're not, I want to make sure you guys really understand, we're not the only guys who do this. It's like buying a car. There's going to be like 14 good options that are all excellent to choose from. So, definitely do the research out there. I do think, honestly, though, Darren, you've put your thumb on it, that, we're a small fund. We have 320 investors. Most of the people who invest with us are either people I know or their relatives or friends of people that I know. There aren't very many of you that I don't know that came through marketing. And Nick and I answer the phone. So if you have a question about something, you can call me and I'll answer the phone and answer your question, which is not something that's going to happen at BlackRock, where they've got literally like $1 trillion they're trying to manage. So it's a very hands-on, personalized service here. So I hope that you, for those of you who enjoy service and working with small businesses in your community, you'll enjoy working with us, I bet. Thank you for asking that.
Steve has a good question here. What component of these funds are coming in from mobile home park investments? Anything at all, Lon?
None that I can think of off the top of my head. It's possible the short-term income fund, which has got about 250 to 300 loans at any moment in time. There could be a couple loans to mobile home parks. I don't know that for a fact, one or the other, but I doubt that it'd be more than 1 or 2%. I know it's under 5%. Medium term is all medical, and in the National Diversified Fund, we've never had anything with a mobile home park. Not that I have anything against it. I just have never seen one where I was comfortable with the risk return profile on it.
And then Becky asked, is this being recorded? Nick, I believe the recording gets emailed out immediately following this. Is that right, Nick?
Yep. Yeah. So the recording will go out if the slides do not go out with it, as they should. But you can email Nick at irontoncapital.com and I'll get you what you need.
Yeah, we're always happy to share that with you. No problem at all. So, what are the benefits of this? We'll do all the finding and touring and due diligence, so you'll have more time to focus on what you want to do, and you'll have a lot more diversification across a couple things: geography, asset class, and strategy. And you just get to deposit the checks and enjoy a nice lifestyle. So, who this is not for is people who want to do it themselves. There's a lot of people who I've met over the 20 years of running a brokerage that have had a dream of being an active property manager and being hands-on, or there's a joy of doing a fix and flip and taking a crummy, ugly property and turning it into something beautiful, or there's a real special joy of being a real estate developer, starting with a crummy house, bulldozing it, putting up something incredible to replace it. I can't replace any of those types of emotions for you. So if that's still what's driving you, you should still be an active investor because there's a lot of wonderful things about that. This is not to diminish any of those things. Who this is for accredited investors who are sort of done with renters, done with all the law changes, and done with all the work that goes into it. So to be accredited, you just need to meet one of these criteria. If you're single, if your household income is over 200,000, if you're a dual income with income over 300,000, or if you have investable assets, not counting your primary, of over $1 million, any one of those three things, we're allowed to work with you. Where can you get the money from? So, Joe, can you talk just briefly a little bit more about the lines of credit with investment properties?
Yeah, absolutely. So that's something that, if you're watching this and you're thinking, man, I've got an investment property that I really like. I don't want to sell it, but I do want to, park some cash over here. Give me a phone call and I'll put my contact information in the chat. We can get you a home equity line of credit to get some cash out of that property. Depending on the type of first mortgage you have, it may make sense to just get a brand new first mortgage and take some cash out of that, or we can get you a fixed second mortgage. So you've got predictable monthly payments on that. So there's lots of different ways that we can take equity out of properties that you don't want to sell, because I understand that too. Maybe you've owned the property for 20 years and you're going to have a huge capital gains bill. I think we touched on that earlier, that there's ways we can offset that, but sometimes it doesn't work. And it makes sense to keep the property and just take some cash out of it. So we have a lot of options that we do with a lot of different clients on that. And it's something that we would do in tandem. Maybe you might talk with Lon or with Nick to kind of game plan, how much equity do I have? What are the ways I want to take it out? And then I can fulfill the need of getting you the new loan or the new home equity line of credit to help with that.
Perfect. Would you be able to put your contact info in the chat box there, Joe, for everybody?
Absolutely.
So different ways you can fund this. You can obviously use cash. If you've got an IRA, actually, Nick, do you want to walk through these? Because you probably talk about this to people all day long.
Yeah, there's a number of ways to invest. You sort of already mentioned it, Lon. So there's cash. So if you have liquid cash in a bank, that's a really easy way to onboard. If you have a self-directed IRA, a lot of times you might have an old employer 401k and maybe you left that job. You have the ability to take that old 401k, roll it into a self-directed IRA, and invest with us through that vehicle. So that's an option. Take cash out with a line of credit on a 1031 property. So if you did a 1031 to defer the taxes, what that references is you can then refinance out of that property, take your capital tax-free, and deploy it with us while still maintaining that 1031 property. Joe referenced the home equity line of credit. Great option for those who have a ton of equity, especially in their primary residence or even their rental properties. But you can often get you can often get much more out of your primary residence if you've got a bunch of equity trapped there. And then, I already mentioned the second mortgage line of credit as well. So all great options. If you have any questions about that, we're always available.
Nick, do you see active investors that are unwinding their portfolio that are on the hunt for a 1031? They're just sort of using us as a backup plan if they don't find something that they like?
Sometimes, a lot of times there's the 1031 investors that maybe they're selling a single family rental and they've got, like the one I mentioned earlier, a couple $100,000, and really a replacement property is still another single family rental that's not going to have cash flow. That might be one type of investor. Another type is an investor that has been managing. We've got an investor that's selling 2 commercial buildings tomorrow. He's closing on it, and he's done being active after 3 years. He wants to be completely passive. He's okay paying the tax bill, even though it's going to be hefty. He just doesn't want to deal with the headache anymore because he's been managing only by himself with his own capital. So, they come from all walks of life, but a lot of times maybe they do see us as a backup, but then a lot of times it switches where the 1031 goes away and now we're in the lead. So everything, regarding that, if you have any questions about it, reach out to us. We're always happy to run an analysis to see what makes sense because everybody's situation is different.
What I've seen with some of our larger investors is that they are a little frustrated, but they're not at the frustration point where they really want to completely walk away, and their preference would be to do a 1031. And then we'll do all the modeling for them to give them their options and tell them, look, if you find a great 1031, you should absolutely proceed with that. But without us as a backup, you've got kind of a gun at your head that you've got to take whatever the best option you find, and that may not be that exciting. You always have the escape hatch of investing with us if you don't find a 1031 that you like a lot. So it's just one additional alternative.
A couple of questions here that are kind of similar. Do any of these qualify for a 1031 to invest?
Yeah, so the IRS tax code is really clear that no fund, including ours, is eligible for a 1031 exchange. So what we will do for you is the long-term diversified fund has a share class that gets all the depreciation, and we can model for you based on our last couple funds how much depreciation we generated, how much generation of depreciation we'll probably have with this fund. We'll come up with an estimate. Obviously your CPA will do a better job, but we'll at least give you a ballpark. We'll give you a ballpark of your tax liability from the sale, and then match them up and see how much of your gain can we offset with the depreciation. In some circumstances, we can offset all of it, so there's no gain. More typically, we'll be able to take out a really big chunk. You'll just have a small amount to pay tax on, but we'll help you at least get your arms around how big would the liability be, and then you'll have the facts you need to make a great business decision.
One other that was on here, Lon, and I know we don't have time today. We're not going to be discussing the National Diversified Funds in depth today, but we've got some upcoming webinars, I believe next week, where we're going to talk about national trends and dive more deeply into the long-term NDF funds. Is that right?
Yeah, if you have any interest in the National Diversified Fund, reach out to Nick. I think his email, Nick at Ironton Capital, is on there, and set up a time. And we've got lots of good education materials about the long-term fund. That's a full hour presentation on its own. We want to mainly talk about parking cash today, but if that's of interest, we're of course happy to get you educated on all that. All right, and last but not least, we've donated a lot of money to local charities the last couple of years, and looking forward to donating a lot more. So we definitely share success with the local community. And if you'd like to do a portfolio review, irontoncapital.com/review is the place to go, and we'll get you set up.
Awesome. I wanted
Yeah,
to.
well, a lot of great questions tonight. This is great.
Yeah, we've got 3 more minutes if anybody has any other questions, so feel free to send them over. We don't have anything. I might add one more thing to one of Darren's comments up above. You mentioned BlackRock and Vanguard. For those of you who are new to this, you've probably seen that you can go buy what's called a real estate investment trust, which is a publicly traded stock on the open market. A lot of people will ask, is this similar to a REIT? And the answer to that is no, right? What's interesting is that a REIT, and this we can go down a rabbit hole on this, but what's interesting is a REIT does not have any depreciation benefits. So a lot of like what Vanguard offers is all public real estate investment trusts that have no tax benefits. And often, even though it's invested in real estate, it actually has a stronger correlation to the stock market than it does to the real estate market. So definitely important things to distinguish. If you're new to this, you might be asking that question, or maybe you didn't know that you had to ask that question, but this is not a REIT. This is a private offering. It's a national diversified fund, or we've got the income funds mentioned as well. But that's a clear distinction. And then we've got another question here from Darren, actually. With regards to the dividends on NTI, any dividends taken out of the investment will reduce the balance of the investment by that amount, but then that amount will continue to compound with interest throughout the year or ongoing, is the question.
Yeah, so what'll happen by default, let's just imagine that you are investing $1 million in MTI, and it's going to be 12%. It'd actually be 12.5 at that level, but just to make it easy, it's going to be $120,000 that you'd earn over the course of the year. 4 payments of $30,000 each. So at the end of that year, you'd be at $1,120,000. So the dividends that get paid out would be $120,000. So the principal amount of the $1 million would just remain the same. So the way we're configured at the moment, software-wise, is that the amount that you invest will stay the same. The dividends we generate, which is the 3% per quarter, gets sent out to you electronically each quarter. So our goal with MTI is not anything from an appreciation standpoint. It's just generating pure income for you. The diversified fund, the long-term fund, is the polar opposite. Our goal is to generate as little income as possible and be all capital gains to the extent that we can, And so it's just a little bit more tax optimized in that way. So they're total opposites depending on what it is you need to accomplish.
Great questions this evening.
Yeah.
Yeah, it's fantastic. Joe, Nick, thank you for joining me, staying up late to do this. All of you guys, man, what a great turnout. Thank you for all your questions, and I look forward to talking in depth with more of you soon. Have a great
Awesome.
night.
Thanks, everybody.
Thanks, guys.
Appreciate you being here.